Okay, so what is something really worth? I mean, it sounds like such a simple question, right? But it's actually one of the biggest, most fundamental questions in all of business. And you might be surprised to find out that accounting doesn't have just one answer, it actually has four. Let's dive in and see how that's even possible.
So, to make this all feel real, let's just focus on one thing: this industrial machine. Picture a company that owns it. Now, if I asked you, hey, put a price tag on that, what would you say? You'd probably think there's just one single correct number, wouldn't you?
Well, what if I told you that according to official accounting rules, this one machine could be valued at 8 lakh rupees, or, maybe 25 lakh, or how about 20 lakh, or get this, a super specific 4 lakh 19,246 rupees. How on earth is that possible? How can one single thing have four totally valid yet wildly different prices? Stick with me. We're going to break it all down.
And look, this isn't just some big, abstract business problem. We all deal with this. Think about the last time you tried to sell your old car, or maybe your laptop. You have to come up with a price, right? So is it what you paid for it? Is it what a brand new one costs today? Or is it just whatever someone's willing to give you for it right now? Each of those questions gives you a totally different answer.
The big difference is, in the business world, this isn't just a guessing game. There's a whole field of study designed to bring some order to this chaos. It's called accounting valuation, and it gives us a set of rules for how to think about an asset's worth. Now, you think measuring something is simple. You use a ruler for length, a scale for weight. Easy. But in accounting, the main tool, the ruler we use for everything, is money. And as we're about to see, money can be a really tricky and kind of imperfect ruler. This quote from Professor R.J. Chambers just hits the nail on the head. See, measurement isn't about finding some single universal truth. It's just about applying a set of rules. So the real question becomes, which set of rules are you going to use?
For example, take a look at this chart. At first glance, it's a great story. A company's sales went from 5 lakh rupees in year 1 up to 5.4 lakh in year 2. That's an 8% increase. Looks like solid growth, doesn't it? Well, maybe not.
Because here's the twist. The moment you stop looking at the rupees and you start looking at the actual number of things they sold, the whole story flips on its head. The company actually sold 10% less. That growth we saw was just an illusion created by inflation. That's the problem with money. Our ruler keeps changing size.
So to get around this problem, accountants break measurement down into 3 steps. First, you figure out what you're measuring. In our case, the machine. Second, you pick your scale. We're using money. And third, and this is the crucial part, you have to decide how you're going to use that scale. And that choice changes everything.
And that brings us to the real heart of this whole thing, the 4 main ways accountants look at value. Let's think of them as 4 different lenses. You're looking at the same machine, but each lens gives you a completely unique view.
All right, the first and most common lens is what we call historical cost. It's the simplest one. It just asks, what did you originally pay for this thing? It's totally objective, you've got the receipt to prove it, and it's locked in the past.
So for our machine, the company paid 7 lakh rupees to buy it, plus another 1 lakh to get it installed and running. So its historical cost is super straightforward. 8 lakh rupees. That's our first value. Simple, clear, done.
Next up, we've got current cost. Now this lens, it completely ignores the past and looks right at the present. It asks, if we had to go out today and buy this exact same machine brand new, what would it cost us?
And this is where things get really interesting. Because of inflation or market shifts, buying that same machine today would cost a whopping 25 lakh rupees. That is a massive jump from the historical cost. But it's a really important number if, say, you need to get the machine insured.
Our third lens is called realizable value. You can think of this as the cash-out view. It's not about what it costs to buy something, but what you could get if you sold it. It's asking, if we put this machine up for sale today, what could we realistically get for it? And that value turns out to be 20 lakh rupees. Now notice, that's different from the current cost. What you can sell a used asset for is almost never the same as what it costs to buy a new one. This is its current market price as a second-hand item. And now for our fourth and final lens, present value. This one is a whole different ballgame. It ignores the past. It ignores the current market. It is all about the future. It asks one simple question: how much money will this machine make for us over its entire life? But
Since a rupee you earn 10 years from now is worth less than a rupee in your pocket today, it calculates what all that future cash is worth in one lump sum right now.
So, after forecasting all the future cash this machine is going to generate, and then discounting it all back to today's money, the answer is just 4,19,246 rupees. Now, this number might seem really low, but this is the one an investor cares about the most because it represents the machine's pure, unadulterated earning power.
So let's just put it all together on one screen. You got one machine and four totally different, totally legitimate accounting values. Historical cost tells you what you paid. Current cost tells you what it would cost to replace. Realizable value tells you what you could sell it for. And present value tells you what it's going to earn. Four lenses, four very, very different stories.
So you'd think just choosing one of those four lenses would be the hard part, right? But believe it or not, it gets even more complicated because some of these values, especially present value, rely on making estimates, basically educated guesses about the future. Check this out. When the company bought the machine, they figured, okay, this will probably last us 10 years. But then 3 years in, some brand new technology comes out. Suddenly, their machine is becoming obsolete way faster than they thought, so they have to revise their estimate. Now they think it's only going to be useful for another 3 years, giving it a total life of 6. And that change in an estimate, it directly changes its value on the company's books. So, after all that, what's the big takeaway here? I think it's that value, especially in accounting, is not some simple single number that you just find.
An asset's value isn't a fact. It's a perspective. It's a choice you make to tell a specific story for a specific reason. Do you need to insure your machine? You're going to use its high current cost. Are you thinking about investing in the company? You're going to focus on its present value. Neither one is more true than the other. They're just useful for different decisions.
And that leaves us with one last really important question. The next time you look at a company's balance sheet and you see the value of their assets, you'll know it's not a simple fact. It's a story. And the real question you should be asking is, which story are they choosing to tell you?